If you work at Western Digital and you've received equity compensation or accumulated a meaningful stake in WD shares over the past several years, you're probably feeling pretty good right now. As you should.
Here, Western Digital is up nearly 300%. Look at that.
The second best performer is Western Digital, up almost 88% for the quarter.
Eye-popping, jaw-dropping gains.
It's been an incredible ride. The stock was trading below $29 as recently as April 2025. As we close in on the end of January 2026, it's trading near $280 a share. Restricted stock compensation has ballooned for many employees, expanding personal balance sheets and boosting confidence. But as the value has steadily increased, so have the questions about what comes next. Because the same thing that builds wealth can also quietly and substantially increase risk. In this video, I'm going to walk through a real-world case study of a Western Digital executive client we've worked with to reduce concentration risk, diversify their portfolio, manage taxes, and strengthen their balance sheet, all with their goals in mind. If you're new here, I'm Dave Wagner. I'm a CFA, CPA, and CFP, and I've worked with families building substantial wealth for nearly 2 decades. And if you're not new, welcome back. Now let's jump into the case study. The situation itself wasn't uncommon. A high-performing executive with a spouse and children at home, strong W-2 income with deferred equity compensation layered in. What made it unusual was the scale. The equity portion of compensation grew exponentially to the point where shares vesting over a calendar year dwarfed their actual salary. A large portion of net worth became concentrated in WD shares, some vested, some unvested. Much of it with significant unrealized gains built in. On the surface, the focus was understandable. Net worth was rising quickly, seemingly by the day. But underneath that growth was a structural issue. Their career, paycheck, unvested shares, and investment portfolio were all tied to the same company and industry. Net worth was climbing, but so was single stock risk and future tax exposure. This wasn't about being pessimistic on Western Digital. It came down to a few simple questions. What happens if the stock struggles at the same time income becomes less predictable? Would long-term financial goals be significantly impacted if WD shares pulled back? At what point does your financial life become too dependent on a single outcome? Ultimately, the client felt strongly that diversification was necessary to introduce predictability and reduce over-reliance on a single asset. The goal was not to sell everything. The goal was to create flexibility. We wanted to reduce concentration, introduce liquidity, and do it in a way that was intentional and tax aware. That meant treating taxes, investments, cash flow, and even legacy planning as one integrated decision, all while staying focused on long-term priorities. Buying a home, saving for retirement, supporting their children's future, and continuing their philanthropic intentions. Before I go further, I want to pause and be clear. At Tidecrest, we built our firm around helping families navigate complex situations just like this. We work with successful families who expect a high level of sophistication, service, and communication. We intentionally keep our client to advisor ratio low so we can provide the attention these clients demand. If this resonates as you watch, there's a link in the description where you can learn more about how we work. Now, back to the strategy. The first step was creating a financial plan. We needed clarity on the full balance sheet, their short and long-term goals, cash flow projections, and a range of possible outcomes. Next, the client implemented a structured liquidity strategy using a 10b5-1 plan. This removed emotion and timing from the equation. A portion of the shares are to be sold automatically over time based on a predefined plan aligned with cash flow needs and long-term objectives. Instead of guessing or reacting to headlines, liquidity became predictable and compliant. Then, we addressed taxes before selling additional shares. We funded a donor-advised fund using appreciated Western Digital and SanDisk shares. As Western Digital employees know, SanDisk was spun off from WD in Q1 2025, and many employees received shares through that transaction, which have also appreciated meaningfully. This allowed the client to avoid realizing capital gains on the donated shares, generate an immediate tradable deduction, and pre-fund future philanthropic objectives. They were already charitable. This simply allowed them to give in a far more tax-efficient way, especially during a year of elevated income. As we diversified the portfolio, we were deliberate about rebuilding market exposure. Rather than moving into broad index funds, we used a custom-built global equity direct indexing portfolio. This allowed us to spread exposure across hundreds of individual stocks while allowing the portfolio to actively harvest losses along the way. Those losses can partially offset gains from selling company stock, both now and potentially in the future. This is where tax planning stops being reactive and becomes part of the strategy itself. All of these decisions were anchored around real-life priorities: buying a home, funding college, saving for retirement, creating long-term family security, and reducing the stress that comes with watching the price of an individual stock dictate net worth and future financial outcomes. Diversification wasn't about chasing returns, it was about reducing concentration risk while pursuing meaningful goals. The outcome was significant. Single stock exposure was tactically reduced, liquidity increased on their terms, tax concerns were reviewed and addressed, and the portfolio became aligned with their family and their future, not just their employer and their industry. Same success story, far less fragility. If you're a Western Digital employee with a significant allocation to company stock, this may sound familiar. This isn't a problem, it's a blessing that requires foresight and a carefully constructed strategy. Every situation is different, but concentration risk is universal. The earlier you start planning, the more options you're going to have. If your income and net worth are tied to the same company, it's worth having a thoughtful conversation about what comes next. At Tidecrest Wealth Management, our team has decades of experience working with families in very similar situations. If you'd like to learn more, there's a link in the description to reach out and schedule a conversation. And remember, this is a case study based on one client's unique circumstances. It is not investment advice or recommendation of any type. It is simply an example of how one family navigated a complex situation through customized solutions tailored to the specific needs. Thanks for watching, and I'll see you next time.